Hello, everybody. This is Professor Lambert on valuation of privately held businesses. We are going to now look into the innards of the comp company model as in the Excel spreadsheet. So this is basically the Excel spreadsheet. I'm in the comparable companies tab down here. And you can see it's populated with a lot of data. There's a lot of cells to look at here. So we're just going to walk through what's in the body of this spreadsheet, so you'll know how to use it for the project. So again, what we're doing here is we're valuing a company that's in the coffee industry, the Chev's Coffee Company, as of December 31st, 2015. That's our hypothetical case here. So what we have is, in the spreadsheet, we have a number of publicly traded companies. So this is going to use the comparable company analysis. We have Starbucks, Dunkin', and some other companies that can be either more loosely or tightly tied into the coffee quick service restaurant industry. For each of these companies, we have their name over here. We have their ticker symbol. We have the fiscal year. So when does their annual year end? And you'll notice this one, this is most of these are 2015. This one is incorrect, I believe. We have the number of shares outstanding. We have the market price per share on the valuation date, so on December 31st. We have the equity capitalization, or what's called the market cap. So again, number of common shares outstanding here in column E times the market value per share, which was column F, equals our equity value. So what this says is that the equity valuation of Starbucks as of this date was $89 billion. Okay, McDonald's was $106 billion, and so on and so forth. Some are quite small. David's Tea is only, and I say the word only in quotes, 106 million market cap as opposed to billion. So some of these are huge companies, some of these are much smaller. We have the amount of debt outstanding for each company, so how much debt did they have per their balance sheet. Then we have the enterprise value. This is also sometimes called market value of invested capital, or MVIC, MVIC. What this really means is, what's the combined value of the company's equity plus debt? Now, I'll say one caveat here. The debt outstanding is not necessarily a market rate of debt, meaning we didn't go to Bloomberg and get the market value of the debt of these companies. Oftentimes, the accounting book value of the debt is used as a pretty fair approximation for the market value. So we're taking the market value of equity in column G plus the debt outstanding in column H. We add those two together, we're getting the enterprise value. And this really, again, is saying what is the value of the company's debt plus equity. These other measures in columns J, K, L, M, and N are accounting measures. So we have revenue, which is our top line on the company's income statement. We have EBITDA and EBIT, and those had to be calculated numbers. We have net income, which is the bottom line on a company's income statement. And you can see some of these are in red and in parentheses, which means this company had negative EBIT and they had a net loss, not net income. And also we have the book value, and this is just a sum of, per the accounting measures, the stockholders' equity total. So remember the accounting equation, assets equals liabilities plus equity? Well, this is what's left over. This is the equity value. If we took that accounting equation and rearranged it, assets equals liabilities plus equity. If we want to solve for equity, it would be equity equals assets minus liabilities. And that's exactly what the book value is. Now you can see that a couple of these companies have negative book value, which means they have more liabilities than assets, which is not ever really a great thing. The reason we do these calculations is, and summarize this information, is we have this data here, which is market data. So this is coming from financial markets. We have this data over here, which is accounting data. That's coming from the company's income statement and balance sheet. And we use these two things to create a ratio or a valuation measure, which is called in the industry a valuation metric. And these metrics are basically multiples of value to a certain accounting measure. And this is the way some companies are priced. What we have here in the next section is we have all those same publicly traded companies, and what we have is the valuation metrics. And there are 5 valuation metrics we're going to talk about. 3 of them are here. The other 2 are over here. Now, the reason we separate these two is because the first 3 measures, this EV to revenue, EV to EBITDA, and EV to EBIT, these are all measures of enterprise value, that's what EV stands for, of the company, to a different income measure per the income statement. Now again, EBITDA and EBIT, we had to calculate those. But these are all enterprise value to revenue, EBITDA, and EBIT. These are measures that look at what is the value of the company's debt plus equity to revenue, the company's debt plus equity to EBITDA, the company's debt plus equity to EBIT. Remember, that's what enterprise value is. It's debt plus equity of a company. And the reason we do that is because if we talk about a measure like EBIT or EBITDA, EBIT stands for earnings before interest and taxes. So that is a measure that both forms of capital would have access to. There's 2 types of capital: equity capital, which means an ownership stake, and debt capital, which means some kind of loan. Those 2 combined make up what's called capitalism. And capitalism is taking money, investing in certain business assets and generating a return on those assets and growing the value of what you've created. So the reason we're looking at enterprise value relative to these measures because revenue, EBITDA, and EBIT are all measures that both forms of capital could be paid with. And we'll talk more about that in class. Over on this other part of the formula, or of the spreadsheet, we have valuation metrics that are direct to equity. So when we talk about the PE ratio, and that's what this column H is, price to earnings, so that's the P is the price of the company's common stock, to E, the earnings of the company's common stock. And usually, if you look at a financial website, P to E is the price per share of a company's common stock to the earnings per share. Earnings per share is an accounting measure also that you've learned about. Price to book is a measure of strictly the equity capitalization of the company to the book value, the accounting book value, so that assets minus liabilities. Now, there are also times when I've seen enterprise value to book value of invested capital, which would be book value of debt plus equity, but we're not going to go over that measure in this analysis. So what is happening here is that for each company, like Starbucks, for instance, we can look at the valuation measures by combining the market data plus accounting data. So Starbucks traded at an enterprise value of 4.8 times revenue, meaning we took Starbucks revenue, multiplied it times 4.8. That's what the company's debt plus equity was worth. So that, remember, that's what enterprise value is. And it was trading at 20 times EBITDA, 25 times EBIT. The company's common stock was trading at 32 times earnings for Starbucks, and it was trading at 15 times the book value of equity. We don't just do this calculation for one company, we do it for all the companies. And we can analyze the data and look at the average and the median of our sample. So we have 1, 2, 3, 4, 5, 6, 7, 8 companies in our sample. And we can look at the average priced enterprise value to revenue metric, the average or the median enterprise value to revenue. And then we can apply that median or that average to our subject company. But here's the key thing, and here's where valuation becomes more of an art than a science. First of all, we don't have to include all 8 of these companies in our sample. This is what we've started with to sort of cast the widest net. and come up with all the companies that could potentially be comparable to our subject company. But we can eliminate companies that we don't think are applicable. So if we think a company has been losing money and that's not comparable to our company, we can eliminate that company. Also, we're looking for trends in the multiple. You can see here that the multiples of enterprise value to revenue are quite divergent, from as low as 0.2 times revenue to as high as 7.8 times revenue. And what we're trying to do is when we go through and eliminate companies that we don't think are comparable, we might have changes to these measures. So say, I'm just going to pick one randomly. Say that we thought White Wave Foods was not comparable, and we deleted that. We deleted them out of the sample. Actually, I'll just do it this way. You can see that our average and our median metric are going to change. Now, don't go eliminate White Wave out of your sample just because I did it. I just picked a random company and I deleted it just to illustrate this. But what we're looking for is some kind of triangulation of these multiples. Do they indicate a clustering around a certain multiple that the industry seems to trade at? If so, great. Maybe that's a great starting point to apply to our company. And we'll talk more about this in class. But the way we would do this is, let's just say we think that 3 times revenue is a good enterprise value to revenue multiple. We would go to our company's income statement and put its revenue in here. And then if we think 3 times is the right multiple, we would put in 3 here. And our implied enterprise value over here would be our company's revenue. And I'm just going to make up a number. Say our company had 10 million of revenue times the 3 times revenue multiple. That gives us an implied valuation of 30 million for our company on a enterprise value basis. We would subtract off the debt and we would get to equity value. And again, this MVIC is also known as enterprise value. So I'm just going to change it to match the terminology we're using up here. Okay, so say our company had 10 million in debt, or say make it 5 million in debt. We would subtract that off, and we'd get an equity value of 25 million. Now, what we would do is we would do this for each of these measures, each of these multiples. So we have 5 indicators of value, and then we can decide which one of those values, which one of those multiple indicators of value give us the best indicator of value for our subject company. Now, this is something we'll have to talk about in class as well, but you don't have to use 20% for each multiple. That's just a something I've put in there as a placeholder. Let's say that every other multiple we thought was not intuitive or didn't give us a good value, and this is again where valuation is an art more so than a science. Let's say we thought that the weighting for this first multiple, enterprise value to revenue, should be 50%, and we think that the EBITDA multiple should be 50%, and we don't think the other multiples are good at all. We think they should all be 0% multiples, 0% used in this analysis. We could put this in, and this will give us a weighted average equity value that is indicating a certain value. Now, again, I haven't populated any of this stuff. So your job when you're going through and pricing your company, the subject company, via this comparables method is going to be to pull in these cells that are in yellow. You're going to pull in the data from Chevs, and then you're going to select a multiple in your group. And here's the most important thing, and then we'll wrap up this video. You will have to come up with a justification and a logical reasoning for why you selected the multiples that you did. And you really have to do this at multiple levels. One, if you've eliminated any companies, then you have to say why you've eliminated them. If you add any new companies in, you should be saying why you've added those in. Here, if there are some of these 5 multiples that you didn't use, you need to justify why or why not. And the ones that you did use, you're going to have to justify them, and you're going to have to justify your weighting here at the end. So this is an uncomfortable exercise at first because no one knows what the right answer is. But remember, you have to justify your answer. This is the gray zone of the real world. There is not a right answer in a textbook. You have to make your best case and logical argument to a judge or a court. Hope you found that useful. We'll talk about it more.